Ugh. Good evening, everybody. How are we all doing tonight? All right, and then we just gotta post this in one more spot. Good afternoon, good evening. How is everybody doing tonight? Go ahead and drop a stacks in the chat if you are one of our normal students who has been joining us for this series so far. So far, we have broken down why Intel is a dog shit company, Jerome Powell's peddling ass speech, and so much more. And tonight, we have the most underlooked thing within, I would say, earnings reports, mostly because it's not the easiest thing to understand, and that would be the balance sheet. The balance sheet is where you can see if a company is being for real or are they faking it? Is what they're telling you just a bunch of hopium that they're blowing up your ass and hoping that you buy into? Are they putting lipstick on a pig, calling it Gladys, and saying it's your new wife? I don't know. But tonight, that's what we're going to go ahead and figure out. So, we got about 5 minutes until this thing kicks off. And let everybody get in here. I actually don't know how many people to expect for this either, so. All right. What, for SPY? All right, who is ready to learn you something about some balance sheets? Go ahead, drop a 1 in the chat if you're in here. If you haven't already, make sure you drop us a follow. I do these classes 3 days a week. Oh, yeah, no, I did not do that. I got hosed on Friday. OPEX fucked me. Well, loaded. At least I know you can follow instructions, unlike the other 7 people in here. But let's go ahead and dive into some Degenomics. Tonight's topic is going to be balance sheets. Income statement breakdowns is another thing you'll hear. And really, this is going to teach you how companies fake profits and, well, really how you can catch it. So, let's talk about this. So I'm going to go over the basics, and then I know Tesla is a hot topic. So we'll go ahead and break down Tesla's balance sheet heading into this Q3 earnings report. So let's go ahead and dive into this. So this is going to teach you what companies want you to see and what they don't want you to see. So we're not talking about options flow. We're not even talking about dark pools. We're not even talking about stock price right now. Yeah, I know, 857. And by the way, we have officially, before this stream started, today we topped out at 104 hours in the last 19 days. So in the last 19 days, we've streamed about 104 hours worth of market data for you guys. Yeah. Crazy. I really didn't know what that was going to look like. But we're going to the basics here. You're probably asking yourself, what the hell even is a balance sheet? Well, it's basically a company selfie. Except instead of filters and fake smiles and fucked up surfaces from poor photoshopping, you actually get to see the truth. It's basically the potential of being catfished, except financially. How much cash they've got, how deep they're in debt, and how much is actually theirs versus the shareholders, because guess what? That matters, unlike what most people think. Now, it's the financial equivalent of checking someone's credit score before dating them, basically. Sure, they look good now, but wait until you see the liabilities that follow. So, the big 3 is what we're going to start off with. And these are the 3 main things that you look at within a balance sheet: assets, liabilities, and equity. Okay? The balance sheet shows what a company owns, owes, and what's left over at a single point in time. Not a whole story necessarily, but just really the snapshot of it. Here's the sacred formula that accountants worship. And no, it's not some complicated ass formula that you think it would be. It's literally assets equals liability plus equity. So in plain English, that just basically means what you have equals what you owe plus what is actually yours. If that line doesn't balance, someone definitely cooked the books in that. Okay? Now, let's start with assets. Think of this stuff as, well, the stuff side of a company. So it's basically like, what do they make? What is the stuff that they have? That would be considered an asset to that company. everything that could, in theory, be turned into money. Now, current assets, those are going to be equal to cash, receivables, and inventory, okay? These are things they can use or sell within a year typically. Cash, that's just literal money in the bank. It doesn't get much more simpler than that. Accounts receivable, this is money owed by customers. Think IOUs, but from your clients, pretty much. And then inventory, well, that's the stuff they built, but they haven't necessarily sold yet. So think of any quantum computer company, or just think of Intel and their foundry business. If current assets are rising, that's usually a good sign, right? But if inventory is rising faster than sales, well, that's a problem, and that's where you get a backlog, right? It's like filling your garbage with unsold merchandise and calling it a success. Now, think about it like this. Tesla once had an inventory spike before Model 3 delays. What's up, Super Gal? That's a signal production outpaced demand in this case. So basically, that's just telling you, hey, more cars were made than people who wanted those cars. Now, the next thing we have are non-current assets. This is the long-term stuff, okay? These are things they can't turn into quick cash. Factories, real estate, patents, and, well, goodwill. Goodwill means the company overpaid for something, like buying a $2 billion startup just for the logo. So basically, Mark Zuckerberg, because he didn't care about prices, he cared about ownership and just getting the right people in the door. What's the dumbest asset you can imagine a company listing? Wrong answers only. Oh, man. Now, if assets are going up, but revenue isn't, this is going to be your first red flag. It might mean they're just hoarding or capitalizing costs to make profits look, well, even better. Think about it like this. When WeWork's balance sheet was growing faster than its income statement, yeah, that wasn't growth. That was just financial bloating at that point. And that's a perfect example of, well, people just wanting to increase their assets, but without having actual revenue to justify buying those additional assets. Now, the next thing is liabilities, or AKA the IOUs, right? Liabilities are what companies owe to other people. So it's like your bill. It's like your phone bill. Basically, the opposite of an asset is the easiest way to think about this. If assets are the dream car, well, liabilities are going to be your monthly payments in this case. So that nice BMW you got that you could afford the payments on, well, the liability in that case would be what you're paying for that car. A healthy, sorry, whoops. I just lost my place. There we go. So, next thing we have are current liabilities. These are due under 12 months typically. These are going to be your short-term bills. So, accounts payable, suppliers waiting to be paid, short-term loans or bonds, and, well, everybody's favorite thing, taxes that are owed. A healthy company can pay these off easily. A struggling one keeps, quote unquote, rolling them over like a maxed out credit card. Intel's foundry segment has a heavy short-term obligation right now. If demand slows, that leverage squeezes margins. So basically, if Intel's foundry business doesn't get their shit together, that demand starts to slow, well, the leverage is going to squeeze the margins on the rest of their business because they'll have to use their cash and other assets that they potentially sell off to, well, cover that bill at the end of the day. Now, long term, whoa, 7-stream watch streak. That's what's up. Long term, these are going to be long-term liabilities, okay? These are big debts and commitments. So think about mortgages, leases, bonds, pensions, obligations, basically everything they've promised future money for. And this is where you find the skeletons within the closet, right? If total debt's rising faster than total assets, it's like buying more houses while you still owe on the last one. So pretty much what like caused the last financial crisis when you had strippers buying 3 or 4 houses and a yacht because they could get a low rate on them. Now, always check debt to equity ratio. This is a very easy thing to look at for the most part. This is going to be your total debt divided by your total equity, and that gives you your debt to equity ratio in this case, okay? If it's over 2, that's a spicy meatball. And if it's over 5, well, it's just cosplaying as bankruptcy. Pretty simple. So 2, that's spicy. Doesn't necessarily mean the world's crashing, but if it's over 5, then, well, get the lube out and make sure you bend over and bite your bottom lip, okay? Now, here's a question for our viewers tonight. Would you rather invest in a company with no debt or high debt but high growth? Go ahead. I'll give you a couple minutes to write your answer and explain why. So now, the next thing we'll talk about is equity. These are the leftovers, basically. So equity, yeah, that would be like your ideal situation. Exactly. Both of those answers are correct. You can have some debt with high growth because that's pretty normal, especially depending on how much, well, cash and money they have in the bank. Same thing with high debt, high growth. Is it risky? Yes. But they typically, if they're not hiding shit, yeah, not all debt is bad debt. But in these cases, bad debt can be bad debt, especially with companies that don't necessarily have stuff that they're selling, right? If they don't really have any assets or a product or anything that they could necessarily leverage to bring that debt down over time, that's where you get into a little bit of a hairy area, right? Now, next thing we're going to talk about here is equity, okay? So equity is the residue of all this. It's what's left for the shareholders after paying everyone else off. So paying their bills, paying everybody, this is what the shareholders have left over. If you sold every asset and paid every bill, whatever remains is equity. Your ownership stake, basically. Does it depend on what kind of market we are in? I mean, if it's hard to get money, like if money's more expensive to borrow, yeah, that's going to be the same as free cash flow, basically. But if money is harder to borrow, then you will see companies taking more conservative approaches and leaning more into their assets because they don't want to take on more debt in a high rate environment because, well, what is that going to do? Increase their debt over time because that interest rate each year is going to, well, increase that balloon between their free cash flow and their debt. Because they'll have to use more of that cash and leverage more of their assets to bring that debt down. So then shareholders are able to get their crumbs, basically. So an example of some equity here. Apple, huge equity, meaning real retained value in this case, right? Speaking of rates, poly market damn near 100. Oh yeah, no, it's not. I mean, that was never a question. If we're gonna get cuts, the question is it gonna be 25 or 50 points? That's the big question now. Intel would be another example. They have shrinking equity due to declining profits and restructuring costs right now. So think about, that's an easy way. Apple, they have a bunch of equity, so they have actual retained value. That's why when you see their stock price fall, it recovers fairly quickly. Intel, well, they constantly have shrinking equity because their foundry business can't get their shit together, aka declining profits, and they have to now restructure to start generating revenue within that business, which is what going to cost them more money, right? Now we have equity components, okay? So first you have common stock. This is what investors own. Then you have retained earnings. This is going to be profits the company kept, okay? And then we have treasury stock, shares the company bought back. Now, if retained earnings are negative, that's a giant red flag, okay? It means the company's lost more than it's made. We call that zombie equity. Again, retained earnings are negative, and remember, retained earnings are the profits that the company kept. That means the company has lost more than it's made. Yeah, no. So after I go through this, we're actually going to use Tesla, and I'm going to like kind of go through their whole balance sheet. But I'm just giving you guys kind of like a more broad overview to begin with, and then we'll get a little deeper into the nitty-gritty of things. So now we have the big three ratios, okay? So you have your current ratio, which is equal to current assets divided by your current liabilities. Oh yeah, no, I get it, man. Then you have this is going to show your short-term liquidity under 1.0 equals a sketchy setup. So anything under 1.0 for short-term liquidity will always be a sketchy setup for this. So again, that current ratio is going to be current assets plus divided by current liabilities, okay? Then we have our debt to equity ratio. This is going to be your total debt divided by the equity. If the leverage risk is over 2, that is a red flag, and that is your debt to equity ratio. So that'll be your total debt divided by your equity. And then you have your cash per share. This will be your cash divided by shares outstanding. It's your survival buffer per stock share. So cash divided by shares outstanding. Okay. So example, let's compare two extremes. Apple, it has a fortress of a balance sheet. So let's go. Why is Yahoo? I still don't know how to switch my thing out of Yahoo search. Or we'll use Tesla maybe. So this is what a balance sheet will look like. You can look at the annual or you can look at the quarterly. The annual will give you more of a long-term view because it's just going to look at each year starting 9/30/2024 as we can see here with Apple. But our quarterly is where we'll get each quarter breakdown. So we have one from 6/30, 3/31, 12/31, 9/30, 6/30. And these are the numbers that you would use. So usually you would only use the last two quarters if you want to find a more short-term view for these, okay? So Apple's current ratio is at 1.3. And again, that ratio is going to be current assets divided by current liabilities, okay? So this, and as you click through these, you'll start to see where these assets lie within, right? So we would take this number at the top because this is a accumulation of everything below here. And then we would do total liabilities at 265. So then that's how they're coming up with that 1.3. Then same thing with debt to equity ratio. So we would look at their total debt. And then we would look at their equity. And that's where we will get our debt to equity ratio. And then cash per share, we would need to look at cash. And then shares outstanding. Now, Intel would be a quote-unquote bad example because they're closer to 0.9. And remember, anything under 1.0 is getting into that sketchy territory. But the closer you are to 1.0, the better off they are. And if it's over 1.0, it's usually a fortress, i.e. Apple, because their current ratio is 1.3 when it comes to that current ratio. Following me so far? Okay, perfect. Now there's a bonus figure that we can look at too. This is return on equity. Our return on equity is going to be our net income divided by equity, okay? And that will come through the income statement. So if it's over 15% for this figure, investors are going to love it. If it's negative, your CFO's probably crying in a corner because he's about to get fired. So those are pretty much, that is going to be your return on equity. Now, Intel versus NVIDIA, okay? Here's an example that we can use. Whoops. Okay, I did not want to do that, but whatever. All right, so as we can see here, we have Intel with about 27 billion in cash, but about 35 billion in debt total. Then our debt to equity brings us to 0.4. Our gross margin's at 30%, but our return on equity is at minus 6%, right? And this is why, FYI, if you want a visual representation as to why nobody understands what NVIDIA is getting out of this deal with them, this is why. This is a dumpster fire. This is you putting lipstick on a pig and telling me it's a supermodel. This is what we like to see, okay? We have NVIDIA, the king, 32 billion in cash against only 9 billion in debt, okay? 0.2 for debt to equity. Our gross margin sitting at 70%, and we're looking at a return on equity of about 60%. Okay? So to give you a little visual of like how these things can look, one looks, just by looking at the numbers, if you didn't know what we were talking about prior to this, well then you could easily go through and figure out which one of these companies looks more attractive to invest into right now. And that's where news and things like that can come into play. Now, one thing to note is Intel's been selling off assets, cutting costs, and praying for AI chips to save them and for everybody and their mother to donate to their GoFundMe page to save their sinking house. That is their foundry business. The U.S. government buying a 10% stake in Intel is basically our first peek into the U.S. government bailing out a U.S. company, because Intel had literally nothing going for them, and that initial cash injection was to literally make up for their losses within their foundry space and to quote-unquote develop chips specifically for the U.S. government. Now, another thing to note here, sorry, I can't look at that white light that much. I keep getting a headache. So, who's the better CFO in your opinion? Type a brain emoji for NVIDIA, or type a crying emoji for Intel. We got 11 people in here, by the way. That's pretty amazing. Are we? Now, three things to remember here. Assets. They tell you the potential, okay? How much dry powder the company has to load into their muskets and blow away their competition. Liabilities, they tell you the risk, how leveraged that potential is. And equity, that's what tells you the truth. who really owns what's left, okay? The income statement, it cannot lie. Cash flow can confuse, but the balance sheet, it doesn't care about your feelings. If you learn to read one page in finance, just make it this one. Okay, so the main thing you want to learn how to read is this guy right here, your balance sheet. Because this is what won't lie to you. So now, what we're going to do is go ahead and break down our income statements, okay? So, income statements, which come into here, because we just talked about balance sheet, the financial selfie, right? That shows what companies own and owe. But now we're going to go a little deeper, and we're pulling back the curtain on how companies turn accounting numbers into what they call quote unquote profit. Think of it like movie magic, except instead of CGI explosions, we've got creative accountants. Now, the balance sheet is a snapshot. The income statement is a movie. So the balance sheet's basically a trailer. The income statement is the full-blown movie, and it shows what happened over time, not just the highlights. It tracks how much a company earned, how much it spent, and, well, what's left over at the end of the day. But here's the catch. Here is the catch. The income statement doesn't show cash. It shows accounting reality, which is basically financial fiction, but with footnotes. So this is your revenue, total revenue up here. This is going to be the famous top line everyone brags about on an earnings call, right? Like our top line revenue. Our revenue grew 20% year over year. Cool, so did my Uber costs. That doesn't mean that I'm doing well. You know, like I spent 20% more on Uber Eats. Does that mean I'm bringing more money in? Probably not. If anything, that means I'm spending more money, potentially. Revenue means the money you've earned, but not necessarily collected. Again, that's where backlogs come into play and other factors as well. Companies can record revenue before they even get paid, by the way. That's called accrual accounting, aka we'll count the money before it's real. Now, some red flags to look for when it comes to revenue, okay? If revenue's growing, but the cash flow isn't, they might be booking fake sales. If they suddenly change what counts as revenue, well, they're now just playing accounting twister. So on earnings calls, when you hear about things that play into revenue all of a sudden that you hadn't heard about before, they're trying to flip the narrative and make a negative into a positive. So, for example, Intel's Q2 report showed flat revenue of about $12.9 billion, right? No magic there. NVIDIA, well, they had 2x growth from the AI boom. That's real demand and Excel wizardry at the same time. Which company's CFO do you trust more? Intel or NVIDIA? I would say NVIDIA's probably. Because also, NVIDIA did not have to overhaul their whole C-level department because they were dropping the ball. Now, every income statement has one section that ruins everyone's mood, and that will be their expenses, okay? This is where you see the difference between running a business and burning cash with style. So expenses include your cost of goods, or COGS. This is the cost to make what they sell, okay? We have R&D, how much they spend to look busy. That's research and development. And then we have SG&A, selling general admin, aka corporate snacks and CEO jets. So that's all the bullshit, all the, hey, come work in our office. You get 3 square meals a day, and you get comped Uber rides, and you get this, and you get that. Yeah, that's all coming out of SG&A, okay? Selling general admin. The lower these are, the better. Unless they cut so much, well, they can't grow at that point. Then you're just kind of sitting around with your thumb up your ass, hoping that the wind doesn't blow. So tricks companies use typically will be capitalizing costs. Instead of expensing something now, they throw it on the balance sheet like it's an asset, which equals instant profit boost. We also see non-GAAP adjustments. This is my favorite. It's like saying, sure, we lost money, but emotionally we were profitable. It's like when people are like, is the profit in the room with us right now? That is pretty much what a non-GAAP adjustment is like. An example here would be Intel's been restructuring, it's been cutting headcount, and it's been selling its assets. That'll show as a one-time charge, which magically disappears in their adjusted earnings, and that's where you hear about adjusted EPS, adjusted revenue, and those adjusted numbers, okay? NVIDIA, they could expense $1 billion in stock comp, and Wall Street would still call it momentum, okay? So what side are you on? Are you on the side of honest accounting, or would you rather see creative accounting? Drop a 1 for honest, drop a 2 for creative. Beautiful. So now we have operating income. And this is the real profit engine, okay? This is where we find out if the company actually makes money doing what it's supposed to. That's the easiest way to put it. Operating income equals our revenue minus operating expenses, okay? So these two right here. And that's what this is going to give us. It's going to be our revenue and then our total rev. So these two here. So if operating income's dropping while revenue is flat, that's a margin problem that they're experiencing. Meaning, if it's rising faster than revenue, that's efficiency. This is what separates the meme and fortitudes like Apple from the meme stocks like Open, for example. Intel's operating margin is 10 to 12%, which is painful, by the way. But NVIDIA, theirs is sitting at about 50 to 60%. It's basically a money printer. That's why NVIDIA's CEO wears leather jackets and Intel's CEO wears stress, because Donald Trump is calling him shit at his job every other week, basically. Now, next up, we have net income. The final number, it's like kind of the final number. It's not actually, but 50-50, it's the final number. This is the line everybody quotes. We made $3 billion in profit this year. Cool, but how much of that is actually real, right? Because here's the trap. Net income includes all kinds of one-offs, okay? Asset sales, lawsuit settlements, tax credits, and good old accounting adjustments. That's why traders look at operating income or free cash flow and not just their net income. So for an example, Intel might show profit from selling Altera, right? Everyone's like, oh, they sold Altera, so obviously they're getting more money. But that doesn't mean their actual chip business made a dime. That could be to cover up for other deficits that they're experiencing. I don't know. Maybe in the thing that's responsible for 24% of their annual revenue, a little thing called the foundry business. And finally, we have margins. And this is going to be how much do they keep. Margins are where traders get their edge out of this whole thing. There's three key types of margins. You have gross margin, which is revenue minus COGS, and this tells you how efficient production is. And then we have an operating margin, right? Revenue minus all operating costs. And then we have net margin, the last stop. After everything, what percent of sales become profit? If you remember one thing, margins equal breathing room. Okay, so the higher their margin, the more margin for error they have, basically. And low margins, that means it's a fragile business. That means if they fart with the wrong person in the room, it turns everybody off and the party's over. It's like taking a shit in the middle of the conference room. High margins, that's a fortress, okay? If we look at an example table of this, let's go ahead and pull our table up. So, we can see here that Intel's gross margin is at about 30% versus NVIDIA's, which is at 70%. Their operating margin, that's at 10%. NVIDIA, it's sitting pretty at 60%. And then the net margin is sitting at 5% with NVIDIA at 45%. Now, this right here is why NVIDIA owns the AI hype train, and Intel is trying to sneak onto the caboose of it right now. Because NVIDIA has set the gold standard of what margins could look like in the AI sector, and Intel shows what happens when you can't get your shit together and you need everybody and their mother to bail you out. Now, here is your trader cheat sheet, okay? Whoops. That didn't work. So your trader cheat sheet, go ahead, screenshot this, do whatever you got to do. I'll even drop it in my chat or in my Discord channel over in IC Trades right now. So that's over there. What the hell? Okay. So we have gross margin. These are basically what the formulas and what the meanings are, okay? So year over year revenue growth, we have sales momentum, EPS, earnings per share, net margin is overall profitability, Operating margin is core business strength, meaning how strong is the actual business. And then gross margin is their production efficiency. Are they burning more cash than they're bringing in? If a company's margins shrink 3 quarters in a row while revenue's flat, that's your early warning system for a stock collapse headed for their next report, unless something big comes out, okay? Now, the next thing we're going to talk about is a case study. We're going to go ahead and talk about our two favorite companies, Intel and NVIDIA. Intel's Q2 income statement reads basically like a hangover. Oh, okay. For the collapse. So basically, if a company's margins shrink 3 quarters in a row while revenue is flat, that's your early warning system for a stock collapse. So basically, if their margins continue to shrink, but their revenue never increases, then that stock is on its way to collapse unless, like, look at Intel, right? Revenue wasn't increasing, margins were shrinking, and what happened? The government, SoftBank, a bunch of other people stepped in and injected a shit ton of money into these people. It's the easiest example to look at, to be honest. Now, let's talk about our case study. So Intel's Q2 income statement basically is a Vegas hangover, okay? Flat sales, declining margins, restructuring costs. Meanwhile, NVIDIA's statement looks like a fantasy novel. Everything lines up, goes up, and is perfectly to the right. Nothing's out of place. So if we look at revenue growth, like Intel, it's expected at plus 1%. NVIDIA was expected at 88%. We already went over their gross margins and their operatings. But if we look at their EPS year over year, Intel lost 40% last quarter. Versus NVIDIA gaining 85%. To give you perspective, Intel is expecting EPS to come in at basically 0 and revenue to only increase by about 14% for this upcoming quarter. And that's with all the cash they just got injected into them. Now, that's why traders don't just look at prices, they look at margins as well. Intel might have government deals and buzz, but guess what? NVIDIA has cash flow and straight dominance. So, quick recap, and then we'll go into our Tesla example. Revenue, that's going to tell you height. Expenses, they tell you discipline. And margins, they tell you the reality. Net income is finally going to tell you how good their PR team is at the end of the day. How good can their PR team spin a bad story and make it look good? Basically, do they have Britney Spears' PR team? So let's go ahead and talk about our babe, okay? That is Tesla. So, Tesla's Q3 2025 financials. Oh. So total assets for Tesla, we're looking at about 115 billion. That's a plus 4% change year over year. And this is showing that they're still expanding capacity. Total liabilities is only at 68 billion. That's up 2%. The debt is modest with low leverage on it, meaning it's barely touching what they have in assets. Total equity, 47 billion. That's a healthy cushion for volatility because that is also a 7% year over year change. Cash and ST investments, we're looking at 29 billion, which is coming in at flat, which is just saying that their war chest is intact. And then we have total debt coming in at 5 billion, which is down 10%. It's down again, which is bullish for the balance sheet strength in this case. Now on their income statement, we're seeing revenue coming in at 25 billion, which is an up 9% year over year. It's still growing, but at a much cooler pace. Gross margin is coming in at 18%. That's down 3 points. But this is also because EV price cuts just took effect. So those are cutting into margins, basically. Operating income's at 3.2 billion, which is down 15%. But that's because they're also spending heavier on AI and energy storage right now. And then their net income is at about 2.6 billion, which is down 12%. Still profitable, but it's not immune to inflation plus competition rising as well, as we know with BYD and the Chinese eating their lunch, basically. Because owning a Tesla in China is basically like owning a Nissan Altima in America. Now, we have operating cash flow, which is coming in at 4.4 billion, which is flat, which is a strong core cash engine. We have investing cash flow, which is at negative 3.1 billion, and that is because of the Gigafactory expansion plus the Dojo capex. We have financing cash flow coming in at 600 million. And this can be accounted for debt repayments greater than new issuances at this point. And then we have free cash flow standing at 1.3 billion, which is flat. And that's plenty of runway for R&D and stock buybacks at some point in the future. So let's start with the balance sheet of Tesla. Whoops, we are in Apple right now. I want... By the way, how you get there, you just search up here, go to financials, go to quarterly, and then that's what this is going to show you, basically. So, the balance sheet that we're seeing with Tesla, we're seeing about 128.6 billion in total assets against around 50 billion rounded up into liabilities. Shareholders' equity is sitting at about 77.3 billion. Cash and short-term investments are at 36.6 billion or 8 billion, and their total debt is at 13.1 billion. So, in plain English, their cash pile is huge. Cash minus debt is sitting at about 23.6 billion. That is fortress liquidity for the EV maker. They have a low leverage, which their debt to equity ratio is coming in at about 0.17. they can cover bills easily. Their current ratio is sitting at 2.04 because their current assets of 61.1 billion divided by their current liabilities of 30 billion gives us that 2.04. And remember, we want to see anything over 1, and the further away from 1 that number is, the more solid the company seems. And even stripping inventory, a quick ratio is at 1.55. So if Tesla sold quick stuff to pay near-term bills, they'd still have room, showing that, well, they're strong. Now, on the income statement of things, which you would go to this sheet, we're looking at a total revenue, we need quarterly, of 22.5 billion. We're looking at a gross profit of about 3.88 billion, giving them a gross margin of about 17.2%. Their operating income is at about 0.92 billion. No, 923,000, Jesus Christ. And then we have operating margin at 4.1%. We have net income at 1.17 billion with their net margin coming in at 5.2%. So price cuts and mix equals margin compression. Gross margin is in the teens. That's a good sign. Now, it's still profitable at the bottom line, but operating margin is tight in this case. Spend on AI/energy/fabs shows up in this area, that operating margin. So sales are big, profits are slimmer. Think busy restaurant with smaller tips, basically. So you're getting a bunch of business, but people aren't tipping as much as you think they would. Now, in terms of cash flow, we have operating cash flow at about 2.54 billion right now. We have capital expenditures sitting at about 2.39 billion. Free cash flow sitting at 0.15. And then we have investing cash flow at 2.94. Growth projects, think factories, AI, energy, all the stuff they're trying to do. And then we also have financing cash flow of about 0.22 billion, which are net paydowns. So quick takes here. Core engine still throws off cash. There's still cash flow positive, though. Heavy reinvestment keeps FCF modest this quarter by choice, and you can think of that as their CapEx. So profits are an opinion. Cash is a fact in this case. Tesla is still generating cash and plowing it right back into growth. So let's go ahead and talk about the scenarios we could look at here. So you can to just break down everything we just talked about, by the way. So this income statement is basically going to tell you how much money came in, how much went out, and what's left over. Think of it kind of like your paycheck. You get gross pay, then bills, then what's left in your account. Revenue is the paycheck, right? Gross profit, that's what's left after you cover the cost of materials. Think cars, batteries, factories, etc. Your operating income is what's left after paying for your staff, marketing, and R&D. And your net income, that's what's left after Uncle Sam and everyone else takes their cut. Tesla's gross margin used to be near 25 to 30%. Now it's about 17%. That's the cost of price cuts, more competition, lower sticker prices, and thinner profit per car. Still, they're profitable. 5% net margin means Tesla keeps about 5 cents for every dollar they sell. That's small, but remember, even Apple was there once. If you ever hear a company talk about margin compression, this is it. More sales does not equal more profit if prices drop faster than the costs do. Now, last piece of the puzzle is that cash flow statement. So cash flow shows actually what happened with their money and no accounting tricks. Operating cash flow, that's the cash from the business operations. Examples of this: selling cars, collecting payments. Tesla's still cash flow positive here. We have capital expenditures, aka CapEx, everybody's favorite thing in AI right now, and it's like a race to see who can blow this number the biggest. That's the money they spend to grow. New factories, robots, AI chips. That's why it's currently negative. And then free cash flow, that's what's left after growth spending. Tesla's still slightly positive, meaning they're self-funding their expansion right now. So if Tesla were a person and they earned $2,500 this month, spent $2,400 fixing up their car for Uber, and still saved $100, they're not getting rich yet, but they're also not going broke either. Does that make sense to everybody? So now, are we ready to go over the scenarios that could occur with Tesla earnings coming up this week? All right. So now that we know balance sheets, income statements, and cash flow connect, let's use what we just learned to figure out what might happen when Tesla reports earnings this week. We'll look at three possible outcomes tonight. The bull case, which is the dream scenario. The base case, which is the realistic middle that most companies come in at. And the bear case, which is the oh shit, time to sell everything and potentially move back in with my parents. And we'll tie back all of this to Tesla's actual financials. So, their Q2 is looking like this. So this was their Q2 data. So cash was at 36.8 billion. We had debt at 13.1 billion, revenue at 22.5 billion, net income at 1.17 billion, gross margins at 17%, and free cash flow sitting at 150 million. So Tesla's balance sheet is healthy, tons of cash and light debt, right? The question isn't can they survive? It's how profitable can they stay while cutting prices and spending billions on these gigafactories and expansion plans that they have, right? And that's the big question everybody's asking. So, scenario one, the bull case, aka everything fires off. Margins bounce back and AI hype finally pays off. What happens here? Well, revenue jumps above 23 billion thanks to record Model Y and Cybertruck deliveries. Gross margins climb back towards 19%. Operating profit doubles to 2 billion and free cash flow is back over $1 billion again. Now, why does this matter exactly? Well, on the income statement, we'd see stronger profits. On the balance sheet, more cash is going to build up. And on cash flow, that means Tesla's self-funding growth instead of relying on new debt to fund that growth. Where most companies, when they want to grow, they have to go into more debt and then justify that debt with growth, i.e. Intel needing to build more factories and them going into debt trying to do so. Now, the market reaction of this will probably see the stock rip about 10 to 15%, and analysts start talking insane price targets again. Bulls call it the return of Tesla's margins. Scenario 2, which is the base case. So again, scenario 1, we're looking for over 23 billion, margins at 19%. The base case, aka this is like in the middle, right? Most likely comes in flat. So what happens? Revenue comes in 2.28 billion, flat quarter over quarter. Given the flow we saw, bull case or base case is likely rather than bear. Yeah, 100%. Because if we go and look at so when we're looking at the base case, so we'll just look at like since the beginning of September, I think would be like a good range. And then we could look at net flow as well. I mean, we can even see in the put to call ratio, we're looking at 1.45 billion in calls against only 466 million in puts right now. So the base case, we're looking at 22.8 billion. Again, that's going to come in flat. We're going to look at operating or gross margins come in at 17%, which again would be flat. Net income stays around 1 billion, and free cash flow is at a modest 200 to 300 million. Now, why does this matter? That means the balance sheet still looks great. Tons of liquidity in it, but the income statement isn't improving. Tesla's basically treading water. It's not sinking necessarily, but it's also not sprinting. The stock would most likely chop sideways, or we'll see a slight dip of about 2 to 4%. Traders wait for guidance on AI and energy before making a move for the long term. Now, scenario 3. Yep. So income statement would be basically stagnant. It would just be like exactly what happened last quarter, which because it's Tesla, we most likely would see a dip, but it wouldn't see like a sell-off or a huge dip off, right? It would be maybe 2 to 4% as mentioned. And then most likely any guidance or news that kind of gives a peek into the future is what is going to give people that blind confidence. Now, scenario 3, which is the bear case and the least likely, I'm thinking for Tesla, for being honest, because I feel like a lot of the bad news is already priced in. While revenue, it comes under 22 billion, which is, 22 billion. It comes under 22 billion in revenue. Gross margin drops below 15%. Our operating income comes in at less than 500 million, and free cash flow is negative. Now, the cash flow statement flips. Instead of adding cash, Tesla starts to burn it. Balance sheet cash shrinks, and debt might tick up, and analysts start asking if growth spending's too aggressive here. The stock could dump 10+% on this type of scenario. This is where we would see a huge sell-off, and Twitter will be full of Tesla margins are dead takes, basically. So here is your cheat sheet. I'm going to go ahead and drop this in my Discord channel as well. So how does all of this connect to fundamentals exactly? Well, the balance sheet tells you if they can survive tough times, basically. So when the shit gets tough, are they going to have to start selling stuff, or do they have enough cash and money to kind of keep them afloat for another quarter or two? The income statement shows how profitable they are right now in this moment in time. And the cash flow statement shows if they're actually generating cash or just playing accounting games at this point. So even if Tesla misses earnings this quarter, if they're still cash flow positive and debt light, that's a sign of long-term strength for the company. So which one do you think we'll see this week? I know Loaded thinks we're going to see the base case, but we also have the bull and the bear. So go ahead, drop a bull, bear, or, a base case in this case for what you think could happen here. Yeah. So, meh. So that is our accounting class for tonight. What now? Yeah, they usually see a run up into earnings and then sell off after and then recover within like a week or two. So how do you feel about this stream tonight? Was this helpful? Oh, facts. Base case is going to get bought up so fucking quick that it might as well be in a positive report. Well, Elon just has to come out and say AI at least 10 times during his press conference, and that will confirm the bull case. Did this make sense? Is this helpful? I never know if how I explain things makes sense to other. Like, it makes sense in my head, but it's because I stare at this shit for like 9 hours, 10 hours a day. So, and do hours of research. Like, I got off stream earlier so I could put this whole thing together. And I wasn't talking much, so thank you for your insight. I typically kept it basic, looking at free cash flow, debt, and year over year, but we got surgical. Yeah, I mean, and that's like because again, you got some creative accountants out there that'll make things look what they may not seem to be, right? As we saw tonight, especially with earnings where it's all about just understanding what the actual bottom line is to give us insight, especially in the short term. That's my whole thing. I bring out the I basically take the bullshit out of the I take the bull out of the shit. Damn, we lost 2 subscribers on Substack. That's kind of sad. Whatever. I guess people didn't like my overposting today. So let's go ahead and talk about Netflix. So Netflix, what is PE effects? Okay. One moment. PEGY ratio, PEGY. Yeah, we can go over that real quick. We can go over that real quick. Because I'm done with my stuff, so it's basically up to you guys what you want to know about. So, PE is basically the price divided by earnings per share. Simple as that for PE ratio. It's basically how many dollars investors pay for $1 of earnings. All right, so think about it like this. Yeah, so how much stock is valued? So Tesla, their EPS for the next 12 months is $3. If their price was at $2.25, then that would put them at a PE of about 75, right? And we're using fictional numbers in this just to make it easy. NVIDIA, let's say they have an EPS of $20 and they have a price of $700. Well, that gives them a 35x PE. And Ford, their EPS, let's say it's going to be $2 and they have a price of $20. Well, that gives them a PE of 10. So for Tesla, you're paying $75 for every dollar that it basically earns, right? NVIDIA, you'd be paying $35. Ford, you'd be paying $10. Now, PE can't tell you if a company's worth that multiple. A high PE might mean it's overpriced, or it might mean it's growing fast enough to earn it. It's a very thin and weird line that you have to walk when it comes to this. Yeah, I mean, unless they can justify it. Unless they can justify it, it's not. It just means that they're growing at a rapid pace, right? So a high PE doesn't mean, oh, they're overvalued. They're overvalued. We're going to get screwed. A high PE ratio could just mean that they're growing at a faster rate than expected. But yes, most times than not, it does mean that they are most likely going to be overvalued. Anytime we've seen a high PE ratio, unless they've had blockbuster killer earnings, like we're talking, we see the Grinch dick of all Grinch dicks in that after hours going into that call. Because typically a high PE is going to have to be justified by what? A high PE is going to have to be justified by them actually producing some kind of product or some kind of partnership or some kind of revenue driving opportunity to justify that. So one way to think about it, Loaded, is instead of like for Tesla saying like, oh, is 75x too expensive? You would think about it like, is Tesla growing fast enough to justify it? So it's not like, oh, is this too expensive? Is the company growing fast enough to justify the evaluation? Yeah. Now, PEG fixes the biggest flaw in PE. It tells you how much you're paying relative to growth. So if Tesla has a PE of 75 and then growth is at 25%, that puts its PEG at 3.0. NVIDIA, if it's at 35 and growth is at 30%, that puts it at 1.2. And Ford, if it was at 10 like before, and then their growth is at 5%, well, then that puts it at 2.0. A PEG near 1.0 means you're paying fairly for growth. Over 2, that's a pricey number. Below 1, that's a potential bargain. So the lower we see in PEG, the better. So for Tesla, the reason why you see it makes sense why you would see a lot of people stay away from it during earnings, right? Because it always just has such a high PE, which most likely means it has a high PEG, which doesn't justify taking that gamble or that risk. But if we can find a PEG that's below 1, we're finding a potential bargain at that point, especially if they're able to deliver during earnings, right? So remember, PEG, we want it near 1.0 because you're paying fairly. That's like a fair price. Over 2, typically that's where you'll see the overvalued. And then below 1, that's where we see the bargain prices where we can get some real value out of those types of moves. So basically all PEG is your price divided by earnings per share plus your earnings growth rate. So again, that's going to be price divided by earnings per share and then dividing your earnings growth rate. So Tesla's PEG equaling 3, that means the market is paying 3 times more than its growth rate suggests is fair right now. In other words, they expect massive future expansion like AI chips, energy storage, and robotics, and if those robo-taxis will actually ever come into existence. At least in the fleet level that he's been boasting about, right? Now, PEGY, that is our PE divided by growth plus dividend yield. So this is our PEGY formula, okay? So in this case, using our false numbers, Tesla, if that's at a PE of 75, a growth of 25%, and a yield of 0%, that puts its PEGY at 3.0 still, right? NVIDIA, if their yield's at 0.1%, that brings them down to 1.16. And Ford, If we're looking at 10, 5, and 5, that brings us down to 1.0. So Ford's PEGY looks amazing because it pays a fat dividend and it's cheap on top of that. Tesla's PEGY stays high because it does not pay a dividend yet. So you're betting on future profits and not necessarily income, right? Because with Ford, you're kind of betting on their income as well. But with Tesla, you would purely just be betting on their profits, which again, are you starting to see why people stay away from companies like Tesla during earnings? So what can we take away from this exactly, right? Well, the fact that Tesla has a PE of 75x in this example, a PEG of 3.0, and no yield, investors are going to rely purely on future growth. Their high PE means that if they have any type of miss, the stock is going to drop harder than a stripper working the lunch shift trying to earn those dollars. And their PEG, meaning growth is already priced in, it needs a massive beat to see that 10% move to the upside initially, right? Because we do know that the Tesla bulls will come out to play late at night, right? So if Tesla beats earnings but guidance is weak, the stock still might drop because PE and PEG were already stretched thin. If they crush or announce new revenue, think AI robotics, well, those high ratios can expand even more and the stock will just explode, basically. Now, to make this a little easier, imagine Yep. It's basically anytime you see a company destroy EPS and rev and then fall off a cliff, it's 9 times out of 10 because their guidance and then their PE was a little too aggressive for the market's liking. And if that guidance comes in weak, then it gives everybody a reason to pretty much sell off, right? So imagine your friend owns a lemonade stand, right? He earns $1 in profit a week. If you pay $10 for that business, your PE is now 10, right? But if he promises he'll grow earnings 50% next year, that's different. That's a PEG of only 0.2 now. Now, if he also pays you a 10% dividend, your PEGY gets even sweeter. And that's how pros decide if something is worth the hype going into earnings and for long-term investments. So, a quick recap for everybody in the chat. PE, that is how expensive a stock looks, right? PEG, that's how expensive it looks after growth. And PEGY, how expensive it looks after growth plus your dividend payouts. So Tesla's high ratios tell us one thing, and this is, I literally made a video on this that we all watched about the AI bubble that everyone said I was a dumbass for saying we were in. Well, it's Tesla's being priced for perfection right now, meaning they need to be perfect and destroy their earnings call, right? So even a small miss could trigger a big drop. And it's not because Tesla's bad, but because it's already priced for greatness based on its evaluation, right? If you watched my AI bubble video, literally my theme of that video, AI companies or anyone that is dealing with AI, they are being priced in for perfection. Oh, yeah. Oh, yeah. Does that make things a little easier? Literally walking on eggshells. Like, they can't say one, they can't even say something that's like a joke. You know what's sad is I think some people think this stream is just how to degenerately go into the stock market because I called it Degenomics. Oh my god. Um All right, I'll see you tomorrow, Loaded. No problem, Super Gal. I'm just happy it made sense to you guys. But if anybody has any questions, I'll be on for about 10 more minutes. If nobody has any questions between now and then, I think we're going to call it a night. We'll be back on tomorrow for obviously our daily options flow stream where we watch options, chart spy, and really anything else that you guys drop in the chat. Last week, we had a great week. We had 2 days where we did around 3,000 to 4,000% off of 4 trades total. So great week last week. We're going to hope to keep it running this week. We got big earnings coming up this week as well. So that's one thing to be aware of. God damn. Yep, SPY's making that overnight climb, 665.28. Anything else you want to cover, or we want to cut it here? We still got 5 people. I don't know. I don't really look at after hours. I was just looking at Yahoo's because it gives me overnight. 8 p.m. to 4 a.m. Ooh, Q's up. Nice. Let's see IWM. Ooh. IWM recovery. Yeah, Yahoo has pretty good overnight charts. Ooh. All right, I'll see you in the AM, Super Gal. Hope everybody has a great night. That's the end of the stream tonight. We went 14 hours today. We got another 8 to 10 we're going to do tomorrow. 100 hours, I'm coming for you. 100 hours, 10 days. Starts tomorrow. Hope everybody has a great night tonight. I'll see you guys in the AM for our daily options flow show. If you haven't already, make sure you go ahead, sign up for Investor Central Club. We got a bunch of great analysts outside of me in there that give call outs daily. You get options flow software that gives you a good idea of what's going on with the markets. Again, thank you all for showing up. No problem, anytime. I love doing this for you guys. Glad you're able to get some value out of it. And I will make sure to see you guys in the next episode. Have a great